So here is the most easiest and most profitable fair value gap strategy you can find anywhere. This strategy has been refined, studied, and has verified to have a high win rate. Alright, so welcome back. This is Sloan Academy, this is Sloan Trades, and in this particular video, I am bringing to you how I trade fair value gaps, basically from the higher time frame, which is the daily time frame. Alright, so we're going to jump directly into it, and if you're just coming new, please make sure to like, subscribe, and share. And if you're a consistent viewer, thank you very, very much for your support. And I hope the videos are benefiting you. All right, so let's get straight into it. So my fair value gap strategy, okay, these are 6 outlines I do every single time I decide to trade any fair value gap. All right, so without wasting time, let's get into it. So the first thing I do is I want to identify market structure. I want to identify the market flow of the market on the higher time frame, either on a daily time frame or on a 4-hour time frame, depending on the particular time frame I want to take my entries from. So I spot out the time frames it's going. Okay, is it trending? Is the market trending in a bullish pattern, or is it in a bearish pattern? Then secondly, I would want to identify the fair value gaps or point of interest correlating with the higher time frame trend. Marking these out is a very, very good step to start so as not to confuse yourself once you step down to the lower time frame. So number two is I mark out the fair value gap on a 4-hour on a higher time frame, either on a 4-hour time frame or on a daily time frame. I mark out the fair value gaps, and then I wait for price to return to the fair value gap. Alright, basically not chasing price. If you chase price, you might end up taking a loss because price has moved or hasn't gotten to a point it would get to, and then you're rushing it to get into it. So you have to be patient, wait for price to come back to this fair value gap, and then you can take your trade. Then the third is you place a limit order at the consequent encroachment of the gap. That's the 50% zone. I think we've spoken about this before. Okay, or you wait for a confirmation candle, whether it's a bullish confirmation or a bearish confirmation. That's bullish or bearish engulfing. Now you can basically wait for these candles on a lower time frame. Let's say you have identified your um, let's say you've identified your fair value gap on a daily time frame. You can step down to a 2-hour time frame or 100 or a 1-hour time frame, and then identify your bullish or bearish engulfing candle. And the fourth thing you might take interest in is finding your entry. So on the 4-hour time frame, it's basically to set the entry from the 50%, which is the constant encroachment. But then when you step down to a lower time frame, which is point number 4, on the lower time frame, on mitigation of your higher time frame fair value gap, wait for rejection and go to the lower time frame, which is the 1 hour or the 30 minutes. Now wait for a break of structure on the 30 minutes and look for a POI, a point of interest. When you've gotten a mitigation on the higher time frame, and probably you're not a very good risk taker, okay, you don't just want to jump into the trade, or you want to give it some time, observe what the market is doing. You can basically wait and go down to a lower time frame, 30 minutes or 1 hour, and then you observe what the market is doing, check for a break or structure, check for a rejection, and you would know when to pick your entry from your point of interest, be it an engagement, be it an order block. Right. So the fifth thing I always do, I always say this every time. Before you get into a trade, mark out your stop loss. It's very important in managing risk. So before taking your trade, determine your stop loss. Place stop loss just below the key level, slightly below for bullish, and slightly above for bearish, and also mark out to take profit. Many people jump into trades without knowing when to beat the market, because one thing is the market is not ours, we're just there to make money and go. All right, so know when to get into a trade and know when to get out of a trade. Okay, so there are a few keynotes to look into to observe why taking these entries. That's I personally I take it as guidelines that I need to do so as to have a very successful trade. So the first one is the higher the time frame of the fair value gap, the stronger the fair value gap. Now this has been verified a lot of times. This has repeated itself. It's a pattern. It doesn't change. The higher the time frame, the stronger it is. If you go for a lower time frame fair value gap, it might not really hold because there might be a very important key level below it and eventually get violated. and you say fair value gap doesn't work, but the higher the time frame, say daily time frame, 4 hour time frame, the stronger the fair value gap. Okay, so 50% of the fair value gap is a fine refinement for a better risk to reward and entry. The 50% is the consequent encroachment, and it's a very good place to set your entry because most times the market looks to come and fill in 50% or even below 50% or maybe 75% of the fair value gap and then moves in a certain direction. Now, this is also important probably if the fair value gap you marked is way too large and you don't want to risk a lot of money. So you can basically set it to refine the entry. Sometimes price can mitigate the fair value gap without reaching the 50%. That's basically price will come, tap into maybe 25% of the fair value gap or like just a snipe entry into the fair value gap and then it goes, therefore causing a missed entry. But then when you have a missed entry, um it's quite easier to have a missed entry than to have a loss. So allow it, the market is not yours, and the next trade you get into it. The next corresponding high or low is your target. Okay, I think we discussed this in a previous video that was just released recently. Draw on liquidity. Draw on liquidity will tell you when to get out of a trade. This is the key level that the market is looking to approach, and then you can take your profits from there. So if you don't still know when to take your profits or when to set your take profits, watch the video on draw on liquidity and you'll find out. Okay, so if price hits target without mitigating the fair value gap or any POI, the point of interest becomes totally invalid. Okay, inducement validates an unmitigated 50% of the fair value gap. Any stop loss refinement is an extra risk of getting taken out before the normal invalidation. I believe you already know this. When you go and refine your stop loss, maybe on a lower time frame, meanwhile you took your entry from a higher time frame, eventually you might be stopped out before the market moves. Okay, nothing is 100%. Always manage risk. Truth be told, yes, nothing is 100%. Even the strategy has a high probability of playing out, but it is not 100% guaranteed that yes, this is what's going to happen. This is what's going to happen. So capital preservation always keeps the game on. Preserve your capital by all means. Even if you take a loss, take a percentage of your capital. Don't lose everything. Don't over leverage. Don't over risk. You learn from every loss, which is actually true. If you know you take a loss, go back, refine, check what you did, what happened, what the market did, how were you swept out, and you now find out the lessons that particular setup have for you. So journal to keep your performance in check. Journaling is a very, very underrated thing that people don't understand. You must journal in order to track your performance. Even if it's difficult, write something down. Okay. Execute without fear. The worst is stop loss as long as the risk is managed effectively. Yes, that is also true. Execute your trades. Execute your trades according to your capital size. Execute your trades. If you don't take full TP at the next high or low, take partials or adjust to break even. Okay. If you don't take your full TP, take partials and adjust. All right. So having run you down through the processes I go in taking my trades, let me just swiftly go to the charts or see if I can discuss a textbook diagram before we go to the charts. All right. So this is yes, okay. Let's discuss the textbook diagram now. So let's say, for example, now I have an order flow, which is an uptrend here. And mind you, this is a daily time frame. This is a daily time frame. And eventually I have an expansion leaving behind the fair value gap right around here. Eventually what the market might do is come back, filling this fair value gap here, dangle a bit. This is where the lower time frame entry comes in now. This is where confirmation entry comes in. So for a risk taker, you're basically taking your entry from, okay, for a risk taker, you're basically taking your entry from this particular fair value gap. As you can see, the market actually came to fill it. Let me increase this. Okay, so as you can see, the market came back and filled almost 75% of this fair value gap. And if you've identified this and you're a risk taker, you can basically take your entry from here Basically, take your entry from the 50% zone, setting your stop loss slightly below for a bullish market, and then take profit at maybe any of the target zones around here. Okay, this is for risk entries, for risk takers. Then if you're waiting for confirmation, maybe like to get a more refined entry or on a lower time frame, you can basically go down to the 1 hour or 30 minutes and then look for something like this. You'll be a retracement and then a break of structure. When you see this break of structure, now it is confirmation that yes, market has changed, and eventually you are now on a bullish move. So you can now wait for an entry down here and then a continuation. All right. So this now covers everything we just said here. This covers everything we just said. Basically, look for your take profits, look for your stop loss, mark out the fair value gaps on the higher time frame so as to have an effective trade. All right. So now going into the charts, we're going to be using USD JPY, and this is the daily time frame. And I'm looking at this zone. Now, if you check the other flow, this is an uptrend. How do I know? You can watch for the highs and lows. This is the high, this is the low, this is the lowest, this is another high, and this is another low created, and eventually it's going up. So this is how I know we are on an uptrend. So the other flow is an uptrend. Now from the other flow now, I would want from the higher time frame, I would want to be identifying my fair value gap. So the only fair value gap that I can see around here is this one. This one right about here. Within it have a lot of within this move have a lot of consolidations. So let's just focus on the structural move and allow whatever happens inside. So this is my fair value gap on a daily time frame. And as you can see, market eventually came back down into it, into the 50%. It should be 50%. Yeah. Okay. How about we do this now? Let me use the gum box so you can have a more refined entry. So here is my 50%. Here is my fair value gap. And market came back after it took off, rallied around here, and dropped into the 50%. Now, something I said about don't chase price. If you had taken your entry from any of these consolidations or these liquidity zones that probably bounced down around here, you're eventually taking a loss because obviously the market is just surrendering in order to sweep liquidity and mitigate this fair value gap before continuing. So if you had taken an entry from here targeting this high and you didn't set BE, probably eventually you'll be swept. All right. So it came back down into this 50% and mitigated and moved. So for somebody who is not planning to be in this trade for a long time, this place should be your target. This area should be your target. And this is a 6 RR trade. Okay. This area should be your target for somebody who's not looking to be in trade for so long. But then if you're going to stay in this trade, then you can probably target this place as you take profits. So having identified this now, let's go down to a lower time frame. Let's not just dive into entries. So from 4 hour I go down to from daily I go down to the 4 hour time frame where everything becomes more clearer. As you can see, this is everything that happened in that particular structure of price. So this is the higher time frame fair value gap, and you can see a couple of retracements, accumulations that are called here. And eventually there was a sweep for manipulation. Many can call it liquidity sweep because eventually, yes, it swept these whole zones, taking orders and then moving immediately. So yes, this also is part of it. All right. So this is on a 4 hour time frame, and we might want to get down lower to a 1 hour time frame or a 30 minutes time frame in order to identify how you can now get into trades without risking too much. That's finding a more refined entry. So this is a 1 hour time frame, and eventually from this 1 hour time frame, this is where the change of character occurred on a lower time frame, on a much more lower time frame. But then if you look at it structurally, you might find out that this was the last low. This is the last low. I mean the last high, sorry. This is the last high. And this was where I would call my initial change of character. This is exactly where I'll look at for initial change of character. Although if you get down to much more lower time frame, you can find out that there are a couple of pull-ups here that you can still mark out, but I would not want to engage with this so as to get a clear structure, because the lower time frame can actually mess with your analysis. The lower time frame can show a lot of things that on a higher time frame it's not considered to be something, so it could mess your analysis. So after I identify this, I would want to identify the last high. So this is an inducement, obviously. This is going to be an inducement here because of the move, and this inducement has already mitigated another block here. So this area now, it's probably neglected because I wouldn't want to risk on something that has already been mitigated and eventually it won't go. So where I'll be looking to take my entries is from this zone, this particular POI after the inducement. That's where I'll be looking to take my entry, from this particular POI after the inducement. And as you can see, it's true I didn't get the whole move from here, but then I got in here. All right, but this is also the cons of lower time frame trading, the cons of finding a refined, much more effective entry. It means that you probably will not get all the moves. You will miss out on some because you are waiting. You are patient enough to wait for what the market will do. So setting my entry below the inducement zone so as not to be swept. And then I take profit at the external range high. Okay, at the external range high, which is basically here. That is where I'll be targeting for my take profits. Okay, so having understood this now, I believe this is not a very difficult concept. Trading fair value gaps is actually easy if you know what is involved. Okay, so to recap, I want to go on a daily time frame again so as you can understand. And on this daily time frame, what did I identify? I identified my fair value gap first, identified my market structure first, my fair value gap second. Then I now went back. I now went down to a lower time frame, say the 4 hours, for example, and I identified my entry, which is here, and then my stop loss slightly below, and my take profit. And then if I want to refine the entry, I go down to a lower time frame, 1 hour time frame or 30 minutes, and then I spot out break of structures or change of characters, and then the POI after the change of characters. I basically look for mitigations, and then I find a way to get into this trade. Now eventually after getting into this trade, I go to my journal and I jot out and I journal, okay, yes, I took this trade so and so day. This is the direction, this is what happened. Eventually if I take a loss on the trade, I'll then come back and study, what did I do wrong, what happened. Okay, and if I make profits, I also journal it in order to track my performance. So journaling is very important. All right, so I think we've come to the end of this video, and I appreciate you for watching. Do well to like, subscribe, and follow, and share to your friends. Thank you for watching, and see you in the next